Hello, welcome to another session of Principles of Accounting. Today we're going to look at accounts receivable, which is one of the chapters, again, you are assigned to read this week. Let's dive into it. Accounts receivable. What is an account receivable? It is an amount that is due from another party as a result of a sale you made on credit or a service you provided on credit. You did some work for somebody, you didn't collect the cash at the moment, you send them a bill, you say, okay, I did this work for you, pay me later. You sold a product to a company or to another person, you say, I'll send you a bill, pay me later. That is an account receivable. Let's take a look at a sale on credit journal entry. Let's just say for as an example, on July 1st, TechCom had a credit sales of $950 to Comp Store and a collection of $720 from RDA Electronics. Let's take a look at how these transactions would be recorded in your general ledger. Accounts receivable would be debited for $950. That's to establish the receivable from the sale that you made on credit. And you credit sales. Sales, which is the revenue account, is credited for $950. And then on the other hand, to record the collection of the $720, you debit cash. Remember, cash is an asset account. When you receive cash, you debit cash for the amount of $720, which is the amount you collected. And you credit accounts receivable or the electronic for $720. So what does this transaction indicate? It indicates that the accounts receivable balance for RDA Electronics goes down by $720 because they owed you $720, they paid you, therefore the account balance is decreased. Okay, and whereas in the previous case, you increase the accounts receivable with that debit entry because you just made the sale, you established the receivable which you expect to collect later. Sales using a bank credit card. I want to point this out because when a customer comes to you and they use their credit card to record it to make a transaction to purchase a to pay for a service or a product, that is considered a cash sale. Why? Because you actually get the money at the time of the sale. They don't expect to pay you later. Okay, so they use their credit card, you get your money. Therefore, what do? You debit your cash for this transaction and you credit sale. As you can see, there is another entry that is recorded here, and that is the credit card expense. Why do you do that? Because when you make a credit card sale, what happened? There is a third party clearing company that is used to process that payment. Therefore, you incur an expense as a result of that sale. And that's why it's recorded into credit card expense. But it's not an account receivable. When there is a credit card transaction involved, it is considered a cash sale, and you debit cash and credit revenue, and also uh, debit credit card expense. Bad debt, well, one of the issues with making a sale on account is that there is a possibility you may not get paid. That's where we talk about bad debt. Bad debt refers to as when your customers' account receivable become uncollectible. You're not able to collect because either the customer doesn't want to pay you or they're not able to pay you. Regardless, you're not collecting on the accounts receivable. What do you do at this point? You write off. You write off the accounts receivable. We will talk about two different methods of writing off an account receivable: the direct write-off method and the allowance method. Let's take a look at each of them, how they work in the next slide. Direct write-off method, how do you record that? Let's take a look at an example. TechCom determines, remember that sale we made on January 23rd, that it cannot collect the $520 owed to it by the customer, JCAN. So if they don't expect to collect, what do? That means that account becomes uncollectible. You book this journal entry. Debit bad debt expense for the amount that is uncollectible, in this case $520, and you credit accounts receivable for $520. Notice you credit account receivable to reduce that account receivable balance because you don't expect to collect it. Okay, remember in the previous example, we credit accounts receivable because we collected on it. This time we still credit account receivable because we're not expected to collect it, but we are writing off the balance. Okay, and what happens after you write off an account receivable balance and that account becomes recoverable? So you collect on the account that has been written off. How do you deal with that? Well, the first thing you do, really, the first entry would be considered a reversing entry of the write-off entry. If you look at this entry here, what do you do? So we debit accounts receivable, meaning we reinstate that account receivable for $520 and we debit bad debt expense. If you recall, that is the entry we booked when we wrote off the account. We debited bad debt expense and credited accounts receivable. As you can see here, this is an entry just like a reversing entry of that entry. We debit account receivable, which we established uh, the accounts receivable balance, and then crediting bad debt expense to get rid of it because it's no longer bad debt expense because we are collecting on it. Then, once you have the accounts receivable, what do? You then record the receipt of the cash. So you debit cash for $520 and you credit accounts receivable for $520. Okay? Now, the allowance method, that is the second method of writing off an account receivable. The allowance method is different from the direct method. At the end of each period, a company estimates total bad debt expense to be realized from that period sale, and they record that amount to bad debt expense. So, two advantages of using the allowance method. It records the estimate of the bad debt expense in the period where the sales is recorded. You don't basically wait until the account is flagged as uncollectible to record the bad debt expense, but you estimate an amount that is uncollectible in the period in which you made the sale, and you record that as bad debt expense. The second advantage is you report accounts receivable on the balance sheet at the estimated amount of cash to be received. So if you establish your account receivable, for instance, for $100,000, if you expect that $10,000 of that sale amount will not be collectible, you would then record your value of the account receivable for $90,000. That is more realistic than recording your receivable for 100,000 and value that receivable as 100,000 and later only to find out you're not going to collect a portion of that. Okay, let's take a look at how the allowance method works. Let's use this example. TechCom had credit sales of $300,000 during its first year of operation. At the end of the first year, $20,000 of credit sales remained uncollected. Based on the experience of similar businesses, TechCom estimated that $1,500 of its accounts receivable would be uncollectible. So at that point, TechCom decides to book this entry to record the bad debt expense. Debit bad debt expense account for $1,500 and credit an account called an allowance for doubtful accounts for $1,500. So if you look at the account balance sheet, the general ledger, you have accounts receivable sitting with a $20,000 balance, and also the allowance for doubtful accounts uh, sitting with $1,500. What this is showing here is the net value of that receivable is basically 18,500. Okay, so that's the net realizable value of your accounts receivable that you expect to receive. 20,000 minus 1,500. So the allowance for doubtful accounts is considered a contra account, which means it's there to offset the value of the accounts receivable. I hope that makes sense. Let's take a look at another example. Okay, so now that you establish your allowance for that full account balance, you have a customer's account receivable that becomes uncollectible. Jay's Kent $520 account is now uncollectible. What do? You book an entry to debit the allowance for that full account and to credit the accounts receivable J Kent. So that is the entry to write off the account. Notice you do not debit bad debt expense. That's when you use the direct write-off method to write off the account. You debited bad debt expense and credit accounts receivable. Now, because you debited bad debt expense when you estimated the amount of the accounts receivable that would be uncollectible, now at this time you do not debit bad debt expense. You debit what I would call your reserve account, which is the allowance for that full account. Now, what I would like for you to know here, if you look at the accounts receivable ledger, okay, when you book that entry, you debit accounts receivable allowance for that full account for $520. Now your balance on this account is now $980. That would be 1,500 minus 520, that would be $980. And then here, when you take that out, so if you try to look at your accounts receivable net value before the write-off and after the write-off, you see it's still $18,500. Okay, so your write-off entry does not impact the uh, the net realizable value of your accounts receivable. Before the write-off entry, you had $20,000 minus 1,500 from the allowance for that full account. That was $18,500. After the write-off, you take you basically say, let me say the accounts receivable balance is $20,000 minus 520 and minus 980 would still give you $18,500. That's what I'm going to show you in the next slide, that the write-off entry does not impact the net realizable value of the accounts receivable. Okay, as stated, the write-off entry does not does not impact the realizable value of the accounts receivable. Okay. Before the entry, write-off entry, the accounts receivable balance had $20,000, and then offset by the $1,500, the balance that we expected to receive, considering the uncollectible amount, was $18,500. After the write-off, the accounts receivable balance becomes $1,980, but the allowance dropped down to 980. So when you do the math on both ends, before and after the write-off entry, the realizable amount for the accounts receivable still remains $18,500. Okay, that's all I had for you today. Hopefully you found it helpful. If you do have any questions, once again, please text me, email me, call me, and I will see you in the next class. Bye.